This video is to be used for educational purposes only and is not intended to replace individual research or licensed investment advice. Unique experiences and past performance does not guarantee future results. Trading stocks, options, and spot currencies involves substantial risk, and there's always the potential for loss. Your trading results may vary. No representations are being made that any software or training will guarantee profits or not result in losses from trading. This is the Premier Trade Forex Report with Scott Norse.
Good afternoon, traders. I'm Scott Norse with your Forex Report. Today is Friday, August 24th, 2007. Financial markets around the world abandoned the risk aversion theme this week as credit fears eased. Consistent gains in the Dow Jones helped high-yielding currencies rebound against the dollar and the yen. The Forex market now seems to be focused on the underlying fundamental picture in the U.S., which is rather weak compared to others in the G7. We had only a couple of U.S. economic releases this week, but it is more a fear of what future data will look like rather than what's hitting the news wires at the moment. This is because data released now was compiled before the recent market turmoil. Today's numbers were actually very strong in comparison to economists' expectations. Durable goods orders in both the headline and core readings surged last month, while new home sales unexpectedly rose. While this news prompted futures traders to pair some bets on Fed rate cuts, the dollar ironically declined further. It is certainly a tricky market to gauge as currencies are being pulled in several different directions by a number of powerful forces. The long-term technical picture of the U.S. dollar is still one of great weakness. As we said, even during its recent rally, the greenback's gains over the last few weeks were merely a byproduct of unwinding carry trades. High yielders fell hard against the yen and therefore slipped against the buck as well. Of course, with the dust settling, now the dollar is challenged to remain buoyant on its own merits. This could prove to be a difficult task. However, one of the saving graces for the greenback is that strong technical support in many pairs that is coming into play now or will very soon if the slide continues. Major moving averages and former resistance levels for the greenback could offer strong support next week, even if fundamentals do not. Traders should keep in mind how many forces are currently at play in the market and remember that the calmness seen this week may simply mean that we're in the eye of the storm. Now to the big picture. In the midst of a credit crisis that began weeks ago in the U.S. and has spread globally, it seems as though traders have not fully thought about what direction to take when the dust settles. So much of the focus has been on the here and now as we awaited more hedge fund failures and other news that could spur massive unwinding of carry trades. Although things on Wall Street were calm most of this week, we do not believe we are out of the woods just yet. A great number of hedge funds and banks around the world have exposure to the U.S. subprime market and will all likely take losses on the underlying securities. However, at the end of the day, it is still the United States and, more importantly, the U.S. consumer who will feel the biggest pain. As more Americans lose their homes to foreclosure and the housing market remains in a recession, the odds of overall economy facing a recession increase dramatically. After all, consumers are the heart of this economy. Many Wall Street players are counting on the Fed to bail them out of yet another mess by cutting rates aggressively before the end of the year. Some believe the Fed funds target will be at a full point lower at 4.25%. Such a scenario should help stocks, while at the same time signaling to us that the economy must be in real trouble. Either way you slice it, this is a double whammy for the dollar and could be the straw that breaks the camel's back. As we said, this week we saw a slight shift from risk aversion to dollar aversion. One clear signal that focus is truly back on a weaker dollar will be when the dollar-yen participates in this move. At such a point, we'll be looking for the greenback to possibly make new lows for the year in most major pairs. Till next week, have a great weekend. Take care.